How's everyone doing? Welcome to the strategy room. We are doing like Saturday edition here this afternoon at 2 o'clock on this August 29th, 2026. I thank everybody for joining me here this afternoon for a couple hours of action and adventure. We've got a ton of stuff on the slate here today. We're going to talk about Kevin Warsh at Jackson Hole, what happened there. Scott Besson with his plans for dealing with the bond market, dealing with interest rates, what was going on with all that. We had very interesting earnings from NVIDIA. Like on the one hand, it was blowout earnings, but there was a lot more behind the tell of the tape, as it were. So we're going to take a look at all that. Canada trade war issues thing breaking out all over the place there. So we're going to take a look at that. AI had a lot of interesting developments this week with Meta basically settling this massive lawsuit. We also have Anthropic gearing up for their IPO. So we're going to take a look at that. I've got a ton of bank news for everyone. Just a million other things we seem to be covering at the same time. I covered a couple of very big episodes this week. We had the fifth bank failure of 2026. We're also going to talk a little bit about Mark Walter and his situation. Obviously, everybody is aware of him selling the Lakers, but there is a lot more to that story. I did a whole episode covering all that, but we're also going to delve into some of the continuous fallout that we had this week as we're going to look at a couple of different articles related to that. And because the fascinating thing about what's happening with Mark Walter is that is not an isolated incident. It's not a one-off incident. This is something that's been going on, and it's not that anything that he did was illegal. I don't believe that they're going to find any type of fraud, or I don't think there was anything that he was doing illegal. It's just that what he was doing was highly questionable, and I think it remains to be seen, but I think you could get into a highly ethical question. Like, in other words, sometimes in life, even though you can do something doesn't mean you should do something. So I think this whole situation with Mark Walter definitely falls into that category. Um so we're going to get in. We're going to talk about all of that today. Like I said, I have a ton of bank news, got a lot of great stuff for everybody. But let's kick it off here. Let's jump in as we always do. I've got the U.S. debt clock. As we had mentioned, we had talked about a lot last week. We are now over $40 trillion in the national debt. That equates to a debt per citizen of 116,000 and a debt per taxpayer of $360,000. Now, I know you all have $360,000 sitting around in the couch. That's chump change. I get it. So this is not a problem at all. We could take care of this pretty quickly, right? U.S. federal spending is at $7.4 trillion. So the spending is now going back up. The U.S. federal budget deficit has jumped back up from about 1.67 trillion back up to about $1.82 trillion. Good job, Republicans. Good job on that. Now, they did change something up here on our clock here. They instituted what they call the chop clock. So I'm not really sure. So this is the fraud, waste, and abuse uncovered and identified by the task force to eliminate fraud established by President Trump on March 16th, 2026 via executive order. So they have announced that they basically found $247 billion of fraud, waste, fraud, and abuse, and that equates to $2,294 per taxpayer. Now, they could have just left Doge in place and could have just let Doge do this, but in their infinite wisdom, didn't seem like that made a whole lot of sense. So now we have this, but of course, still haven't arrested anybody. They supposedly have found $247 billion in fraud, but no one's been arrested. Interesting, right? I don't know about anybody out there, but I know if I would have committed $247 billion worth of fraud, I think I would be arrested pretty quickly. So now we get to the federal debt to GDP is at 122, almost at 123%. Now, what I don't want people to confuse that with is consumer debt to GDP, because the consumer debt to GDP is what has been more in the news headlines recently, if you will. So consumer debt to GDP just went over 100%, is probably hovering around 100 to 102%, but the federal debt to GDP has been well over 100% for quite some time now. Now, interest on the national debt, $1.121 trillion. Now that is just the interest that we are paying just to service the national debt. Now, I want you to think about this for a second. U.S. federal spending, 7.4 trillion. So out of that 7.4 trillion, you are basically spending $1.1 trillion just to service the national debt. Now, think about that another way. How much money does the federal government actually bring in tax revenue? Well, they bring in a little bit more than 5 trillion, basically about $5.3 trillion. This is why we have the budget deficit, because we spend 1.8 trillion more, that the government spends 1.8 trillion more than what they actually bring in the door. It's actually what they bring in the door, like I said, is probably about 5.2, $5.3 trillion dollars. So think about it this way. Of the money they're bringing in the door, 5.2 trillion, you're paying out 1.1 trillion in interest just to service the national debt. That means basically one out of every $5 that the government makes, okay, they're spending just to cover the interest on the national debt, not pay down the national debt, just cover the interest. So just kind of keep these things in your mind, because week in and week out, as I go through all the numbers and we talk about all these different stories, all this stuff plays in. This is why I always spend a few minutes going over this stuff. Some other interesting numbers they added here: total U.S. debt, $114 trillion. Of course, that doesn't include all, like, that doesn't include Social Security and Medicare, the bills that haven't come due yet. Credit card debt still stays at $1.3 trillion. That equates to a debt per card holder of $8,362. And defense spending still sitting there at about $974 billion. But President Trump has already made clear that he wants to increase that up to $1.5 trillion. So we'll see what that happens, if that happens or not. So that's that. Now let's take a look at interest rates. Now, before we jump into our whole conversation on Kevin Warsh at Jackson Hole and Scott Bessent and what he's doing with the Treasury and everything, let's take a look at currencies. Well, no, I'm sorry, bonds. Let's take a look at bonds for a minute. So very interesting week here for bonds. Now, this is the 1-day chart. I want to look at the 5-day chart here, so because I think this tells a better tape. So the 30-year bond has come back down here to about 5.125%. It's cooled off a little bit. The 10-year Treasury had come back down a little bit here. We were looking at, I think this was like on Wednesday, we were down to about 4.629%, and then it just shot right back up to 4.724% here. So in other words, what we're seeing here, for, like, again, you look at the 30-year, you look at the 10-year, we go down to the 2-year, you kind of notice a pattern in all these charts here, and that is that at the beginning of the week, Scott Bessent comes out and basically says, in other words, last week, Scott Bessent came out and said, we're going to do a $4 billion buying, right? And that was like, a little gnat, a mosquito to the bond market. It was not, I mean, the bond market looked at that, shrugged their shoulders, and were like, yeah, whatever. What does that mean? What does that do? So Scott Bessent basically came out on Monday and he just opened both barrels. So basically said, yeah, we're going to throw $1 trillion at this thing. And of course, that had initially, early in the week, that had the desired effect, as you saw here with the 10-year Treasury. So on Monday, he comes out and says, oh, yeah, we're going to hit this, with $1 trillion. And then by, Wednesday morning, it's down to 4.62. Things are calming down. But then a lot of the questions start to come out. Scott Bessent starts to get critiqued by Druckenmiller, which we're going to talk about that in a few minutes. Then everything basically starts to reverse itself back up. And then you had a little bit of craziness on Friday because of Kevin Warsh's comments at Jackson Hole. So like I said, we'll get into all that in just a minute. But So what is the point here, though? What does this really mean? Well, interest rates remain elevated, but they have calmed down just a tad. Okay, things have definitely they've calmed a little bit. Things haven't gotten crazier than they were, but I do not believe this roller coaster is over just yet. I think there's more here that needs to play out. But we'll get to that in a second. Now, what was the other effect of this? Well, we saw crypto, Bitcoin primarily, really jump. I think crypto had gotten, or not crypto, but Bitcoin had gotten up over 81,000 earlier in the week, but then dropped back down to basically about 78,000. But definitely seeing, Bitcoin pick back up. If we go over to commodities, gold futures, again, gold picked up. It was down a little bit yesterday, but for the week, it kind of picked back up to about 4,500. Silver futures, again, the same thing, kind of picked up earlier in the week and they kind of fell off a little bit. But Brent crude oil. Now, Trump did make it, I didn't have anything to cover that, but Trump did announce a deal with Venezuela that I think got announced either late last night or early this morning. Brent crude oil here sitting at $84. I'm sorry, just crude oil futures sitting at $83. Brent crude futures sitting at $88 right now. So again, it's kind of like the same thing with interest rates. Has it gotten any better? Has it gotten any worse? Just kind of staying neutral, if we will, here for the week so far. Now, let's take a look at interest rates here for a second. The 30-year again, residential mortgage rates here. So mortgage and refinance interest rates for today as of Saturday, August 29th. So according to average rates from the Zillow Lender Marketplace, fixed mortgage rates are slightly higher heading into the weekend compared to Friday. The current 30-year fixed rate today, it rose by 1 basis point to 6.55%. The 15-year rate increased by 5 basis points to 5.91%, and the 5/1 ARM fell by 5 basis points to 6.26%. So again, just looking over our rates here as of today, again, just to recap, the 30-year is at 6.55, 15-year fixed at 5.91%, the 5/1 ARM at 6.26, and the 30-year VA mortgage at 6.11%. Now, if we look at refinance rates not all that much different. The 30-year fixed is at 6.51%. 15-year fixed at 5.89%, the 5/1 ARM at 6.19%, and the 30-year VA mortgage at 6.07%. So not a huge discrepancy here between regular mortgage rates and refinance rates. But again, we have seen mortgage rates jump up on us. Again, that's going to hurt, continue to hurt real estate sales because that's going to crimp affordability. And I think at least what we're seeing from the real estate market right now is it really depends on where you're at in the U.S. If you're in the northeastern part of the United States, everything, real estate sales, everything continues to be pretty status quo. Everything has remained pretty solid. If you're down in Florida, I think we're starting to see Florida slowing down a little bit. Florida was ultra red hot for probably the last 5 years. I think we're finally starting to see Florida just, slow a tad. And again, you go over to the west. Again, you could, if you're in Arizona, if you're in Utah, Colorado, like, again, could be a different story. Could be seeing a much weaker market, could be seeing more of a buyer's market. So again, I really think it just depends on what part of the country you're in right now is going to dictate whether these interest rates here either work for you or don't work for you or work against you at the moment, as it were. So, but like I always said, we'll continue to keep an eye on it and see what happens there. All right, now, two big things here before we get into our Jackson Hole conversation. This dropped, and I was this dropped like a hammer. Banks fought against stablecoin. Now they are considering launching their own. So executives are on defensive as companies outside of the banking system launch coins. So banks large and small have started to warm up to the idea of their own stable coins, despite early doubts from some executives that there will be much demand for them. Some bank executives over the past year had shrugged off the need for stablecoins, and the industry waged a lobbying battle against crypto firms that wanted to offer stablecoins that would act like bank deposits. Instead, banks banded together to launch a tokenized deposit system as an answer to the rapid changes in the world of payments. Stable coins are digital tokens pegged to the US dollar or other currencies, while tokenized deposits are just traditional money represented as digital tokens. Now, I've done a couple episodes talking about obviously just stable coins. What are they? I've done episodes on tokenized deposits. I actually just did an episode on what are tokenized deposit networks. So again, all really interesting, fascinating stuff. So if you want to go and take a look at all that or do a deeper dive, check out some of those episodes out there on the channel. You'll be able to find all that great stuff. But now a number of banks have started to consider whether there could be a need for both, even if only as a defensive play, as some executives worry stablecoins could encroach on their businesses. But big non-bank companies such as Visa, BlackRock, Google, and DoorDash have moved to get involved in the stablecoin market, which has been dominated by Tether and Circle, the two largest stablecoins out there on the market right now. JP Morgan Chase recently evaluated whether it could launch its own stablecoin, according to people familiar with the matter. Now, again, JP Morgan, they have been working on JPM coin for a couple of years now. So this didn't just, sneak up on them. This is something that they have been working on for a little bit there. But those conversations have been primarily, and there is no active product underway. Another person said, I don't know. I necessarily believe that. The largest U.S. bank already has a tokenized deposit called JPM Coin and its own blockchain. Yes, so there you go. While we have no plans to issue a stable coin, depending on customer demand and the evolution of the regulatory landscape, we would, of course, evaluate all options in the future, a JP Morgan spokesperson said. Many banks are focused on joint ventures, though some could end up both in consortia and with stablecoins of their own. A group of more than a dozen financial institutions, including Bank of America, Wells Fargo, and Santander, has been moving forward on a stablecoin venture that would reach across the globe, according to people familiar with the matter. The banks have discussed plans for a stablecoin that would be focused on the commercial side of their businesses and cover the dollar, followed by the euro, and eventually other group of 7 currencies, according to some of the people with use cases that could vary by region. Smaller banks are working on similar initiatives too. On Tuesday, a consortium of state bankers associations unveiled their plans to launch a blockchain platform built for, owned, and governed by banks, inspired by the Federal Home Loan Bank model. The platform is meant for banks of all sizes. Currently, some 39 state bankers associations representing about 3,000 banks are involved in the effort. Yes. So again, if you want information on that, that is a tokenized deposit network. There are 4 different ones out there. Like I said, I just did a big episode on all that. If you want to get the deeper dive and all that information, go check that episode out. So, but again, I think the point here, what is the main point of this, and why did this hit like such a big thing in the last couple of days? Well, banks have been adamant. The banking lobbies have been adamant in this pushback against stable coins, against the crypto regulation, the Genius Act, the Clarity Act. They have really pushed back on this stuff, basically saying we don't want stable coins to be able to pay anything, to be able to offer any type of incentives or rewards or anything like that. And now all of a sudden you have this change of heart here real quick. Like, why? Well, obviously the Genius Act is passed into law. We're waiting for the final rule that I believe is coming from the OCC on the Genius Act, which is going to come in November. Now, the Clarity Act is still sitting. It's still hung up in the Senate, where it's been stalled in the Senate for 7-8 months now. And we're waiting to find out what's going to happen here after the Republicans come back from September. My guess is that something is going to get done with the Clarity Act. Will get done. It will get signed into President Trump. My guess is that it will happen very quickly, and probably by October that will be signed into law. And the part of it is a political reason, because Republicans they got to make it look like they're doing something before the midterms, so that they could put this through. Then they could say, oh, hey, we got all this crypto legislation done. So I think that's part of it. I think the other part of it is that both sides have probably gotten to a point where they've come to some type of agreement here as to how this is going to work out. And now this is basically the way of kind of the information getting put out to kind of soften the narrative around it, to basically be like, okay, yeah, we fought the stablecoin thing, but now we're gonna kind of start to embrace this a little bit, because the reality of the situation is going to begin to set in very quickly once the law goes, once the law becomes signed, it becomes actual, becomes a real thing. Then banks are going to be forced to have to deal with it. So again, but this is big. This is big because this is a major. This is the beginning. This is the beginning of a major narrative shift here. So again, that's why I wanted to cover this first, because this is it's just one article here in the landscape of things, but it's big because it's a signal. It's like sending up a giant signal beacon. So we're gonna keep a very close eye on this over the next few weeks here to see what happens. So all right. Now let's go in here. So, real quick, the Fed's preferred inflation gauge. It basically shows that core prices rose 3.3% annually in July. So, prices consumers pay for a variety of goods and services rose slightly in July, according to the Federal Reserve's main inflation gauge, which is known as the Personal Consumption Expenditures Price Index, otherwise known as the PCE. Which the Fed uses as its preferred forecasting tool, increased a seasonally adjusted 0.2% for the month, putting the annual inflation rate at 3.7%. The Commerce Department reported Wednesday both were 0.1 percentage points above what the Dow Jones consensus. But stripping out volatile food and energy costs, core PCE posted respective gains of 0.2% and 3.3%, in line with forecasts. While the Fed considers both measures, policymakers generally see core inflation as the better measure of long-term trends. The report also showed that personal income rose 0.4%, while spending increased 0.2%, both stronger than expected. Goods prices actually declined on the month, off 0.1%, driven by a 2.7% decrease in gasoline and other energy related goods, and a 0.9% drop in furnishings and long lasting household equipment. Services prices rose 0.3%, pushed by a 2.1% increase in financial services and insurance, as well as a 0.3% gain in housing. So, what does this really tell us? This tells us that, again, inflation continues to remain elevated. The CPI reports and the PPI reports, which I covered last week, did show slightly easing numbers. Inflation backing off a little bit in June and July. We'll see if that holds true for August. But again, here with the PCE basically showing this slight increase here, as opposed to, I think the hope here was that the PCE was going to continue to kind of back off a little bit, just like the CPI and the PPI did. Now, while the core numbers remained basically in line with expectations, like I said, the overall number jumped up. So again, it just adds to that concern with the Fed of hey, inflation remains elevated. What can we do to try to bring this number back down? So now that is a great segue into our conversation here on Mr. Warsh. But oh, you know what? Sorry, I skipped one thing here real quick. So I just wanted to point this out real quick. This was an interesting article. 6 months into the Iran war, and markets become accustomed to the stalemate with no end in sight. So 6 months after the U.S. and Israel launched major combat operations in Iran, the conflict has settled into a prolonged standoff with no clear end in sight. The Trump administration has shifted toward economic pressure, including planned secondary sanctions, as it pulls back from further major military escalation. Experts told CNBC the strategy is unlikely to force Iran to capitulate quickly, while continued attacks across the Strait of Hormuz keep escalation risks high. Yes, I do not believe that. I don't believe these economic sanctions are really going to do a whole lot here. This is Again, this has become a nasty stalemate with a lot of ups and downs, a lot of back and forths. But I think the important thing here is that this headline, the market becomes accustomed to the stalemate. It becomes accustomed to the stalemate, which means that, as I think Trump has had a certain ability to kind of calm the markets, to calm oil back down, like, oh, we reached a deal, this is going to be over, and then oil comes back down, then the couple days later, oh no, it didn't happen, rates right back up. So I think it's kind of like, the boy who cried wolf, right? Like, you cry wolf one too many times and people just stop listening, they start ignoring you. And I just think that it's obvious that we are reaching that point where it's like, okay, we're entering into this stalemate. This thing is going to last longer than I think probably many people thought, or were hoping that it would end quickly. But now we're starting to turn to kind of our worst fears, that this thing is going to basically continue to drag on with no real end in sight, and it's going to continue, unfortunately, to devolve into a mess. I really don't think these economic sanctions are really going to work. Um, I think at the end of the day, Iran will continue to get the things they need. They'll continue to get them from, China and a bunch of other countries around the world that they're already partnered up with, and that's, again. So again, I guess, it's good that they're trying to do something else. I mean, I think the worst thing you could do is have boots on the ground in there and have Americans dying over there for what? I, you know, but I think that's the worst case scenario, and we'll see, continue to see what happens here. But yeah, my continued for whatever my 2 cents are worth, my continued opinion is to just end it, bring everybody home, get out of there. Sign some piece. Who cares what it is? Sign something. Find some kind of nonsense peace deal. Sign it. Get out of there. Have them agree to just say that the strait is open back up, whatever, and just bring them back home and get out of it, because there's no win here. Like, there's no win. There's no like, I don't know, like, if when you say, like, what are we doing? How are we doing it? And what's our win at the end of the day? There is no win. Like, there's no win. There's nothing to win here. There's nothing to be gained. It's just like, okay, you tried to do this. You tried to bomb them into oblivion. You've messed up their military and their air force and their navy and everything. Great job. Nice. You put a big crimp on their economy and everything else. Okay. They didn't surrender. They didn't wave the white flag. They didn't give up. They're not going to give up. So, okay, you tried. It didn't work. And now it's time to call it a day and come back home. So, but I don't know. But like I said, unfortunately, I don't think that is most likely going to happen. But we'll see. All right. Anyway, getting back to Jackson Hole here for a second. Let's go. So, Fed Chairman Warsh expresses concern about inflation and advocates for a quieter central bank. So, Fed Chair Kevin Warsh, in his speech on Friday at Jackson Hole, avoided committing either to forward guidance or a reaction function for monetary policy. Instead, Warsh used the presentation as a broad look at his approach to governance. We should not indulge a regime in which market participants are looking primarily for the Fed for their next trade, he said. While this summer's inflation readings were better than expected, they do not tell me that underlying trends have meaningfully improved, Warsh said. Now, a couple bit. We're going to go. Like I said, I got a couple articles here. We're going to go through them and kind of take a look at what's going on there. What's the big takeaway here? First of all, I want to say this: if you have not had a chance to watch Kevin Warsh's speech, is probably 30 minutes, maybe 35 minutes, something like that. The speech is a great speech. It's a phenomenal speech. Like, watch it. I think he did a great job with it. But there's a big difference here between giving a great speech and giving the market what they wanted. Did he give the market what they wanted? No. No, he did not. And how do we know that? Well, we just go back to the market data, and market was down slightly here over the week, and then we saw bond rates shoot. But looking at the chart here on the right, we saw the bond rates cruise back up here on Friday. So that just tells you right there, he did not give the market what they wanted. So Scott Bessent started the week off by giving the market what they wanted with him announcing a $1 trillion, buy package. But Kevin Warsh did not give the market what they wanted necessarily. And he really pushed back on the idea of forward guidance. However, Kevin has a very uphill battle. He's got a huge uphill battle. Now, why do I say that? Well, I'll show you a couple things here real quick. So, you have two of the Fed governors out here, and what are they saying? Fed Hammocks says now is the time to act on raising interest rates. So, Cleveland Fed President Beth Hammock told CNBC on Thursday that the central bank needs to act now to bring down inflation. Even with recent data indicating a slowing pace of price increases, the policymaker said she worries that the impact inflation is having on household budgets. Hammock was one of the three dissenters at the July Fed meeting who favored a rate hike. Then we also have this. Kansas City Fed's Schmidt says inflation is stubborn and sticky, but the policy rate is not restrictive. So Kansas City Fed President Jeffrey Schmidt said Thursday that inflation has been stubborn and sticky, though he did not commit to supporting an interest rate hike. However, he said he doesn't see the current level of rates being restrictive on the economy. Schmidt also voiced support for an idea that Chairman Kevin Warsh raised to reduce the number of Fed meetings per year. So again, it's kind of hard for Kevin Warsh to do his job and basically say, I want to do less on forward guidance when you constantly have these other Fed governors out there constantly putting their 2 cents out there. Now, it's a difficult thing. I've said this in the past. The Fed governors here, they love their 5 minutes, right? They love their 5 minutes in the spotlight. They love to get out there. They love their hits on CNBC and Bloomberg. They love to get up there. It makes them feel special, makes them feel like a star, makes them feel famous. They love their little hits on the networks and everything. The market loves, again, the market is basically, if you listen to Kevin Warsh, what he's trying to explain to you is that the market, instead of the market having to do their own work, they're addicted to the Fed just coming out and basically telling them what's going to happen, telling them what to do. Like, oh, well, we're going to do this, guys. So, you go ahead and place the right trades and everything, right? The market loves that. What the market doesn't like, when the Fed's like, well, we don't know what we're going to do yet, guys. We're still thinking about it. When we do something, you'll find out, now they got, oh man, now they got to sit there and figure it out for themselves, right? They don't like that. They do not like that. So, so again, I think, but how do you, if you're Kevin Warsh, and this has basically been the way that the Fed has operated over the last, the better part of the last 17, 18 years with a lot of these Fed governors, particularly voting members on the FOMC board, coming out to basically give their opinions on a lot of this stuff. How do you basically walk in the room and say, hey guys, sit down and shut up and just shut up, stop doing these hits, whatever. That's not going to go over very well, right? Like that's just, you can see that conversation in the boardroom that's not going to go over well. And then you'll get these guys coming out like, oh, Kevin Warsh he's telling me I can't speak and he doesn't want me to say what's going on and blah, blah, blah. And this, so that could turn kind of nasty or ugly real quick. So again, he's got his work cut out for him. And again, I just try to show these as a couple of very quick examples. But let's go back to this for a second here. So 4 takeaways from Kevin Warsh's first Jackson Hole speech. So Fed Chairman Kevin Warsh advocated for a little more conversation, a little less action in Jackson Hole. So let's run through. So what are the 4 big takeaways? So the inflation fight. Number one, they're still looking at that 2% inflation target. They still want to try to get that down. Number 2, don't call for forward guidance. Again, he's pushing back on this idea of constantly telegraphing. It's the telegraphing of what we're going to do, right? Number 3, market reaction. Over the years, markets have reacted to the Fed chair's remarks at Jackson Hole. Oh, yes, they have. And then number 4, the economy today. So the price stability side of the Fed's dual mandate is the central bank's core focus and will drive its decision-making in the near term. For the rest of the economy, Warsh is pleased by its resilience. So those are kind of the 4 big takeaways. Now let's dive back into them for a second here. So I kind of missed. Wait, where did I miss it? Where did I miss it? Okay, inflation fight. Here we go. And you know what? Let me make this a little bit bigger here. There we go. Now everybody can see this. Everybody can follow along now. Okay, so reiterating his previous public comments, Warsh was adamant that the Fed must restore price stability and bring inflation back to its 2% target. While summertime headline readings for the Consumer Price Index and the Personal Consumption Expenditures Price Index were better than anticipated, underlying trends were less favorable. They do not tell me that underlying trends have meaningfully improved, Warsh stated. We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do. That's our job, our mandate, and our charge to keep. The central bank chief noted that the Fed is committed to a discipline, not to a decision. He referenced core PCE, excluding food and energy, firmly above 3% as the key focus for policymakers. That's why I wanted to talk about that before we got into this conversation, so you'd understand, like, okay, why is he saying 3%? We covered that. Now you know. Warsh may have refrained from tying the Fed to a particular direction in the next month, but markets suggest he likely tilted a bit more hawkish in his 3,500-word speech. Based on the 2-year Treasury yield, which generally tracks monetary policy expectations, traders are pricing in higher interest rates, but the near-term outlook suggests traders are split on whether the Fed will put the trigger on a quarter-point rate hike or stay the course. Chairman Warsh seemed to clarify for detractors the overall message and possibly leaned more hawkish, but there was nothing earth shattering. Brian Anderson, head of fixed income at Laffer Tengler Investments, said in an emailed note to the Epoch Times. Bond markets have normalized and are helping with restrictive conditions, but maybe not enough for the chair. Sounds like the Fed is data dependent still. So now I want to show everybody one thing here real quick. I want to show everybody today's Wall Street Journal. So let's see here. What is the big article here? Warsh signals rate increase is on the table, right? And then what does it say just below that? Traders take note, right here. Traders take note. Bet that the hike is coming. So here again, you have the Wall Street Journal Business Press, and in today's Saturday weekend edition of the Wall Street Journal, basically saying that, oh yeah, the rate hike's coming. Kevin Warsh said so. No, Kevin Warsh did not say any such thing in his speech on Friday. Kevin Warsh basically just said that yes, he said, and we're watching inflation. We're concerned about the number. It's remaining elevated, but we're just going to continue to see what happens. Kevin Warsh did not say anything. I mean, again, some people can interpret this and say, oh, he seemed more hawkish. He seemed more dovish. But the reality is that people are probably 50-50 split here. But again, and I call it the Jerome Powell wing, because Jerome Powell, he's still sitting there, and believe me, he is the shadow chair, and he has a tremendous amount of influence behind the scenes, tremendous. And I have no doubt that he wants to increase interest rates, and he's got his disciples. Where am I looking at here? He's got his disciples like Beth Hammock right here, who's out there like, oh yeah, we need to increase rates. We need to increase rates, and then they put out these articles, like I said, here in the Wall Street Journal, like, oh yeah, he signals that he's going to increase. He signals right here he's going to increase rates. He told us yesterday. Like, no. He did not say that. He did not say that. That wasn't the tone or the point of his speech. I think he put a lot more emphasis here on forward guidance. Don't call it forward guidance. Forward guidance has overstayed its welcome, Warsh declared before an audience of economists, policymakers, and Wall Street behemoths. Changing how the Federal Reserve communicates to the public has been one of the key reforms introduced by President Donald Trump's pick to replace Jerome Powell. Fed Chairman Alan Greenspan had slowly introduced the concept of forward guidance in the early 2000s. The idea behind his communications tool is that financial markets will carry out some of the central bank's policy objectives. His successor, Helicopter Ben Bernanke, then bolstered its relationship with the public through regular press conferences during the global financial crisis. But this mechanism has produced a hall of mirrors situation, says Warsh. The rationale is that investors have relied heavily on forward guidance to inform their next trade decisions rather than on real time economic information. The hand holding can also backfire as the Fed looks to markets to interpret data, leading to policy mistakes, he noted. A quieter Fed, more purposeful in its communications, is better able to meet its objectives, and we can be held accountable for delivering on our remit. The only true test of our credibility, Warsh said. One of the monetary task force will concentrate on how the Fed conveys policy deliberations and decisions amid uncertainty. Former Bank of England Governor Mervyn King is a member of the group. Minutes from the July policy meeting revealed that Warsh proposed holding 6 scheduled meetings per year, held about every 2 months. This, the meeting summary noted, would allow information to accumulate between meetings and enable greater assessment. And yeah, I see nothing wrong with that. If the Fed only wants to meet 6 times per year, basically every 2 months, like I think that's fine. I don't see anything wrong with that at all. But again, what Warsh said here, a quieter Fed, more purposeful in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our own remit, the only true test of our credibility. And just, I mean, beautiful. And that's what I'm saying. What it was a great speech. But there is a difference between it being a great speech and delivering what the market was looking for. I don't believe that I don't believe I think he delivered a lot of stuff that the market was expecting him to say. But I also don't think that he gave them what they wanted for it. I'll tell you what they wanted. Okay. What did they want? What was their expectation at the end of the day? They wanted him to come out and say that he was going to hike interest rates. Okay, they wanted him to say, okay, we're going to hike up rates probably 2 times before the end of the year. We're going to do a couple of 25 basis point rate increases so that they could again put all their trades in. What did he say here? The rationale is that investors have relied heavily on forward guidance to inform, wait for it, their next trade decision rather than on real-time economic information. In other words, they're waiting for the Fed to tell them what to do instead of having to do their own homework. Okay, that's the whole point of what's going on here. And there's a lot of truth to that. And what he's saying is that the Fed, by telegraphing what they're going to do, can get the markets to do some of the things, kind of do some of the lifting for the Fed. But at the same time, when this becomes the norm, when this becomes the pattern, basically you risk a lot of this could lead to a lot of policy mistakes, which it has. And that's the whole point of what he's trying to display here, is that we've got to get away from this. We've got to get away from all the forward guidance and telegraphing everything that we're going to do. But like I said, what the markets wanted was, they wanted him to come out and say, oh yeah, we're going to increase rates, we're going to do a couple of interest rate hikes, couple 25 basis point hikes. But there's a but to this. But they also wanted him to kind of back up what Bessent was doing with the $1 trillion package. They wanted him to follow that up by basically saying, like, oh yeah, we will commit. We're going to turn the printing press back on, and we're going to rev back up the Fed's balance sheet. And we will, if Bessent needs $1 trillion, we'll give him $1 trillion. If he needs $2 trillion, we'll give him $2 trillion. That's what the market really wanted him to say, and he didn't say it. He did not give it to him, and that's why when Bessent came out and basically said what he said, it had the desired effect at the beginning of the week. But then after Warsh did his comments on Friday, you saw things begin to drift back up, because Kevin Warsh did not explicitly give them what they were hoping for. Now, again, with the paper here, with the Wall Street Journal, this is the minions on Wall Street, basically trying to, even though Warsh didn't say Warsh didn't say what they wanted him to say. So now they're basically putting the words in his mouth, is basically what's happening there with those Wall Street Journal articles. And that should be highly concerning to everybody. So, but anyway. All right, now as far, again, the market's reaction. So over the years, markets have reacted to the Fed chair's remarks at Jackson Hole. In August of 2024, U.S. stocks rallied when Jerome Powell declared that the time has come for policy to adjust. The blue chip Dow Jones Industrial Average gained almost 500 points, and the tech-heavy NASDAQ Composite Index surged nearly 300 points. 2 years prior, when Powell warned that businesses and households would experience some pain, the Dow Jones fell more than 1,000 points and the NASDAQ lost close to 500 points. This year, the equities arena hardly reacted to Warsh's speech. The Dow Jones and the broad market S&P 500 were little changed. The NASDAQ slipped about 100 points. Warsh used the marquee slot exactly as the new chair, setting the tone for his tenure should, unambiguously. Natalie Lojewski, managing director at CIFC Asset Management, said in a note email to the Epoch Times, the message was that markets, not the Fed, should be doing the forecasting, and investors waiting for a pre-committed reaction function will be waiting through his entire term. Yes, exactly what I was just saying. Yes, exactly, 100%. So again, the market's reaction was just, blah, because what did Kevin Warsh give them? He gave them blah. It wasn't, he, like I said, he did not give them what they were hoping to get out of him. So again, we continue to sit here wondering what's going to happen. Now, as I said a few weeks ago, Kevin Warsh, he does have these committees that are working. They're supposed to get back to him. Their time frame is December. So these committees are supposed to get back to him by December, and then we'll find out what it is that they will or won't do at that point. So now let's get and then they kind of have this like analysis. Kevin Warsh sharpens inflation warning at Jackson Hole, signaling possible rate hike. Like I said, no, he didn't. He did recommit to the Fed's 2% PCE inflation target and said elevated prices should be the central bank's main focus. However, and I'll go back to our debt clock here, okay? Federal spending, $7.4 trillion. Okay. How do we get inflation? There's only one way we get inflation, and inflation comes from government spending. It's the government spending way too much money. It's the government injecting too much money directly into the economy. That's how you get massive amounts of inflation. And the only way to cut that back is to wait for it. What are we going to do? We're going to cut spending. We're going to reduce spending. That's how you get the inflation back down below 2%. The Fed, here's what happens. So can the Fed increase interest rates and get the inflation back down? They can. But what happens? What do you think happens when if the Fed were to increase interest rates back, I don't know, 100 basis points, 150 basis points, what happens? The economy goes into the tank because it slows everything down. All of a sudden, everybody starts buying stuff because rates go way up. They stop buying houses. They stop buying cars. They start putting money on the credit card because it just becomes too expensive. They can't afford it. Therefore, the economy slows way down. Economy might even drop into a recession at that point. So, and then you got to go into a recession there to dramatically try to reduce inflation. But what's going on at the same time? Government hasn't changed. Government hasn't stopped doing anything. They're still spending money into oblivion. They're still destroying the value of the dollar. They're still increasing prices on everything. It is literally extremely difficult for the Fed. Like, I think that we are stuck. The Fed, I think the Fed doing its best job might be able to get inflation back down to around 2.2, 2.3%. I think that's about it until the government gets serious about cutting the spending, reducing this massive out of control spending. Until this happens, the Fed is, I've talked about this concept in the last couple of weeks of fiscal dominance, right? So what does fiscal dominance mean? Fiscal dominance is where everything you see here on this chart here, the 1.8 trillion federal budget deficit, having to spend 1.1 trillion on the national debt. What is going to happen here is in the next 3 years, that national debt is going to go up, it's going to balloon up to $50 trillion. The interest that you're going to spend on the national debt is going to go over $2 trillion. You're going to have to spend over $2 trillion. Okay. At that point, you now have what's called fiscal dominance. Like and in other words, the options of the government become less and less, right? Because they got to spend 30% of their money just to pay the interest on the national debt. Like that, and at that point, you reach a point where the Fed on the monetary side they just can't do anything. They have no control over it. They could do things, but it's not going to matter. You're going to be in a period of fiscal dominance where the only people that can do anything to address the problem is the government itself, the national government. That's it. Um, it's a massive problem. It's a massive problem for the Fed. So, like I said, the Fed they could do, they could say, oh, we're going to do this and we're going to do that, whatever. But the reality is, like, they can't do it all by themselves. They've got to. They really need the government, i.e., Congress, to do their job, to get back on this and massively reduce this spending. Um, but again, there's just no um there's just no appetite amongst, whether it's Democrat, Republican, there's no appetite to reduce the spending. None. What do the Republicans want to do? They want to ramp up the defense budget. They want to ramp up the defense spending. What do the Democrats want to do? Democrats they want to ramp up the social spending. They would spend money on every harebrained scheme in the world like that. But that's where we're at. Like, but nobody wants to cut the spending. Neither side. Nobody wants to cut the spending. All right. Well, anyway, all right. Well, I'll get off my soapbox there on that. So, all right. So basically, what is the big takeaway there with Kevin Warsh? So basically, Kevin Warsh says that he wants to really reduce the forward guidance. He wants to put emphasis on the inflation. Like I said, I think that unless something crazy happens, if the inflation numbers stay tame, and as long as the labor market does not tank, I think Kevin Warsh is just going to stay. I think he's going to try to stand pat the rest of the year and just see what happens. And then we will go from there. But that's kind of my feeling in the best case scenario. But we'll see how the economic numbers play out. Now, I did have this article here that I wanted to get into, but I've got a lot more I got to hit here in the next hour. And I'm not going to have enough time to go through this, but it was interesting. It was Warsh's old forecast show how he formed his views on inflation. So as a Fed governor 15 years ago, Warsh was more worried about inflation than nearly all of his colleagues. And for years, it didn't materialize. Yes, but then until it did. So, but I'll probably have to save this for next week. Because it is a very interesting article about how he kind of formed his opinions, but it's going to require more time than I've got today, because I want to get into the Besant stuff here. Now, on Monday, Scott Bessent comes out and he basically says Bessent could tap nearly $1 trillion Treasury general account to fund bond buybacks, sources said. So the Treasury could use its general account to help fund purchases of government bonds, according to two senior Treasury officials. Now, Treasury Secretary Scott Bessent says he has built up the TGA to around $850 billion currently. The Treasury surprised markets last week by doubling the size of bond buybacks, but the impact on yields was short-lived because of skepticism over the firepower available to Bessent. Yes, I think that's fair. Now, so what, again, as we talked about here, so what happened during the week? Well, yields decline on CNBC report that the Treasury could use general account to fund buybacks. Like we said when we showed at the chart here. Let me go back. So again, if we're looking at the chart here, again, beginning of the week, first couple days, rates go down. The rates started, Monday we're at 4.736 on the 10-year Treasury. And then here by Wednesday, we're down to 4.626. So Bessent comes out with the bazooka, says, I'm hitting it with $1 trillion, and it has the desired effect. He calms the market down and the rate starts to trickle back down, right? So then we get all that, and then we get to we get this, the initial decline, but then we get to the skepticism, so we get like the debasement trade returns after Bessent bond maneuver. Crypto and gold are back in style. The government spending concerns have given a second wind to the debasement trade. Gold and Bitcoin have surged in recent days, while the U.S. dollar has pulled back against peers. So yes, we did see a pop initially early in the week in gold and silver, but then that definitely calmed down by Friday, as we had talked about a little bit earlier ago. But then we got this, okay? So Bessent puts out this plan, and then Stanley Druckenmiller, legendary billionaire, investor on Wall Street. I believe he was even one of Scott Bessent's mentors. But Stanley Druckenmiller leads doubters who think Bessent's bond ploys will fail. So billionaire investor Stanley Druckenmiller casts doubt on whether the Treasury Department's recent bond market maneuvers will be successful. In a published op-ed, Druckenmiller said Treasury Secretary Scott Bessent's efforts may not only fail to bring down government bond yields, but also damage the department's credibility. Druckenmiller was a mentor to Bessent when the two worked for George Soros. So Stanley Druckenmiller comes out with this criticism. The only problem is, he didn't write it. He didn't write it. Druckenmiller's surprising critique of Bessent was delivered with the help of AI. No, not delivered with the help of AI, written completely and 100% by AI. And then he says, well, I'm kind of proud of using AI. The legendary hedge fund investor says of the technology. So Wall Street was stunned Monday when Treasury Secretary Scott Bessent was taken to task by one of his friends and mentors, legendary hedge fund investor Stanley Druckenmiller. In an open article for the Wall Street Journal, Druckenmiller sharply criticized Bessent's move to intervene in the U.S. bond market, saying that stepping up government buybacks to bring down yields was a mistake. The journal's opinion pages operate independently. But Druckenmiller said that there was no dysfunction in the market that would warrant such a move, and that high inflation and runaway federal debt were among the forces driving up yields. So he was right and he wasn't right. In other words, he was correct that high inflation, runaway federal debt were among the forces driving the yields. Yes, but to say that there was no dysfunction in the market that would warrant such a move, no, absolutely not. I mean, obviously you saw the takeoff in interest rates, so no. Scott Bessent has to do something. He has to do. He's reacting to the market. He has to do something. He can't sit there and not do anything. If he sits there and they're trying to really turn this into a kind of a damned if you do, damned if you don't type moment, where if Bessent basically, if he sits there and does nothing, they're like, oh, what's this guy doing? This guy, he can't make a decision. He can't react. He can't do anything. The interest rates are flying back up. This is going to cause all types of turbulence in the market. So if he does nothing, he gets criticized. If he comes out and says, we're going to pump money in here, we're going to try to calm the market down, calm interest rates back down, and he gets criticized for that as well. So, but the point here is, in an interview, Druckenmiller said that he used AI to help produce the piece. I was a B student in English, but an A plus in economics, he said. These are my ideas, and I've been speaking about them for over 15 years. As anyone who knows me knows. Would I prefer that I was a great writer? Yes, but that's not who I am. So he got extremely lazy and decided to let AI do the heavy lifting here for him, which again I think is kind of an embarrassment to him. And again, this guy comes out and he levels this criticism on Scott Bessent, which I think is really unfounded at the moment. But look, maybe this works, maybe it doesn't work for Scott Bessent, but Scott Bessent doesn't deserve this criticism. Not right now, not at the second. And I would say to Stanley Druckenmiller, where were you? 4 years of the worst Treasury Secretary in the history of the U.S., Janet Yellen. When she was manipulating the market every other month, she was manipulating treasury auctions. She was manipulating payments. She was doing activist treasury issuance, ATI. Where was Stanley Druckenmiller when all that was going on? He didn't have nothing to say. Where was he when she purposefully, intentionally, basically drained all the money out of the treasury account and left Scott Bessent day one with nothing? With nothing. Like where was Stanley Druckenmiller then? I didn't see him. He didn't have a whole lot to say then. I didn't see him using, ChatGPT to put out all of his comments then. It's ridiculous. It's ridiculous that this guy, again, does Stanley Druckenmiller deserve a lot of respect? He does. Guys had an amazing career. He deserves a lot of respect. However, does this come out and seem really hypocritical when he's out here laying this, but he had nothing to say when Janet Yellen was just riding us into oblivion? He had nothing to say about any of that. All that was fine. All that was cool, right? So it's just very disingenuous on his part to come out and say this stuff, and he embarrassed himself with the fact that he basically had to use AI to write a one-page op-ed in the Wall Street Journal. Like, give me a break, man. All right, now here's the interesting part of this. So Besant moves test the boundaries between the Treasury and the Fed. So Treasury Secretary's plans to buy back long-dated debt is the latest in a string of moves raising questions about his ambitions. So Federal Reserve Chairman Kevin Warsh takes the stage here Friday with an unusual presence looming over him, a Treasury Secretary stepping closer to terrain long treated as the Fed's. The overlap figures to be among the most discussed subjects among central bankers on the sidelines of the Kansas City Fed's annual symposium. Pushed far enough, it risks blurring the lines between the central bank and the administration. The Fed sets policy to manage inflation and employment, not to make it easier for the government to fund itself. Treasury Secretary Scott Bessent surprised markets last week by announcing the Treasury would at least double the government's buyback of long term debt. His goal was to push down yields that hit 19-year highs. That process could loosen financial conditions at the very moment the Fed may want to tighten them. This comes as the central bank is already weighing a great deal. It is debating whether interest rates are too low with inflation above target, and Warsh is remaking how it communicates with markets. Earlier this month, Bessent pressed the Fed to make more dollars available to foreign central banks to support his recent effort to help Japan prop up the yen. He has also taken an interest in who runs the Federal Reserve Bank of Atlanta, which has been without a chief executive since March. He has argued for more than a year that the Fed is too concerned about inflation, breaking with his predecessor's custom of not commenting on monetary policy. Bessent's words and actions are a real pain for Warsh, given broader concerns that monetary policy could be subordinated to financing the government at a time of elevated inflation. Um, the Treasury rejects the idea that any of this reaches for a new power or bends monetary policy to the government's funding needs. Prior to the global financial crisis, debt management decisions were solely at the discretion of the Treasury. Under Scott Bessent, Treasury is reclaiming them to fulfill its mission of funding the federal government at the least possible cost to the American taxpayer over time. Now, so this is the part, and again, I have been on my soapbox about this for months and months and months, and that is this idea. um the Treasury rejects the idea that any of this reaches for a new power, right? A new power, or bends monetary policy to the government's funding needs. Prior to the global financial crisis, debt management decisions were solely at the discretion of the Treasury. But I don't know, this kind of idea right now amongst the mainstream press, mainly because they just, they hate Trump, whatever. But mainly this idea that, like, oh, well, you can't talk, like Scott Bessent can't talk to Warsh, and Warsh can't talk to Scott Bessent, and these guys can't coordinate their actions to the benefit of the economy and to the government and for the people. They no, 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 no. We can't have these guys talking amongst themselves and working to figure things out. That's a no, 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 no. That then they're just doing Trump's bidding at that point, whatever. I mean, it's just so stupid. It's so stupid. It's like, yes, do I want the Federal Reserve Chair and the Treasury Secretary? I hope they talk daily. I hope they talk every day. I want them coordinating on how to figure this stuff out. I want them talking to people in Congress. You need everybody in the boat rowing in the same direction. You can't get things done if everybody's not rowing in the same direction. Trump's biggest problem here it's the same problem in the second term as his first, and that is he can't get everybody rowing in the same direction. He had Jeremy Powell fighting against him. He's got Congress not wanting to do anything. That's a problem. Could you imagine what could happen if Jerome Powell had basically said, yeah, I'll work with you guys to figure this stuff out? If Congress was like, yeah, we're going to come in and cut spending. If everybody was rowing in the same direction, imagine what our economy would be doing right now. It would be booming beyond belief. Again, if all these things actually happen, but unfortunately they aren't and haven't. But again, this idea that Besant is somehow, I don't know, he's going to try to take over the Fed, or he's going to manipulate the Fed or whatever. Like, no, I'm not buying that. I'm not buying that for a minute. Besant has a job to do. He has to fund the government. He has to try to keep interest rates in check in his own way. That's his job. That's what he has to do, and he's trying to deliver on that. Now, do I will say this: is the timing good? No, no, timing is not good here. Kevin Warsh just got in. He's just getting his feet wet. He's trying to, set the tone, trying to set the pace, and all the stuff that Besant is doing is not that does not helping Kevin Warsh at the moment. It's not. It's not, but um just like Scott Besant, Kevin Warsh, he stepped into a very difficult situation. He stepped into a very difficult situation, and not something that is going to be easily remedied in a few minutes, or in a few months, or even a few years. The problems that we have deep rooted problems in our economic systems. I could think of our economy as a very complex system. We have very deep seated, deep rooted problems in that complex system, and it is not easy to fix a lot of these things. It's one thing when people are rowing in different directions, but even if everybody's rowing in the same direction, some of these things are very difficult to fix, because everything has trade-offs, right? Everything, you do this, it breaks that. You'd go over here. That messed up this thing over here. Again, you're not going to fix these deep-seated, deep-rooted problems. You're not going to fix them without having collateral damage in this place or that place, or here, there, or otherwhere. It's just that is the trade-off. That is what's going to happen. These guys, both of these guys, Kevin Warsh and Besant, they both fully understand that. They fully understand that, when, okay, if I do X, it's going to lead to X, Y. It's going to, if I do A, it's going to lead to X, Y, and Z. They understand this. They're well of us in this. But look, Besant's got to do what he's got to do, and Kevin Warsh has got to do what he's got to do. I just hope that these guys work together to try to figure this situation out. Would I love to see Scott Besant come out and basically say, what? I'm going to sit down with the Fed. I'm going to talk to him about this. We're going to see if we can figure something out. And I would love to see Kevin Warsh say, yeah, you know what? I'm going to go over and talk to Scott Besant, and we're going to see if, he needs money. He's got to do this, that, and the other thing. We've trying to prop up Japan. So we're going to try to see if we can work a little bit with that. Now, is that the same thing as forward guidance, right? Because I can hear some of you right now going, well, wait a minute, you just talked about forward guidance and all this stuff, and now you want to talk about, is that forward guidance in a sense? Yes, it is, because you are basically saying that you're telegraphing that, yeah, okay, I'm going to come out and I'm going to help Besant do X, Y, and Z, and we're going to try to get this resolved, whatever. Yes, okay, that is a form of forward guidance. That is a form of telegraphing. Is it an absolute direct form of forward guidance? No, it's not. I think it is. I think it is a little bit just saying that, hey, you're going to sit down and try to work and try to solve a problem. Again, that's just what I expect them to do. That's an expectation of just doing your job, right? I don't. Again, I don't look at that as forward guidance. Like, we'll find out what happens when hopefully the two of them get together and say, hey, we're going to do a joint press conference, and this is what we've come up with, or this is going to be our plan. This is what we're gonna try to do. Um, I just get incensed when, it's again, if Jerome Powell and Janet Yellen, if they decide to get together and work on something and do something, that's totally fine. That's totally fine, no issue, whatever. But if Warsh and Besant were to try to do that, oh my gosh, Scott Besant's trying to take over the Fed, and he's got too much power, and this is just, Trump manipulating everything. Like, it's ridiculous. It's like, stop. All right. So, and let me see here. All right. So, other Fed news here. But before we get that, I just want to say one thing here. Scott Besant, this is not over. The story's not over yet. There's a lot more that's going to happen here. We will see, how this plays out. We'll see what happens here over the next few weeks. My guess is that this is going to be a little bit of a roller coaster. My guess is we're going to have a couple good weeks. We're going to have a couple bad weeks, but we'll see what happens here. I would say as we get in through September and October. September and October should be two very interesting months this year, but we shall see. But let's go on to some of this other. I just want to hit this real quick, and then we'll get out of the Fed stuff because I've got economic indicators and bank news and all the other stuff I want to get to you guys here. So, but Fed's Lisa Cook turns mortgage allegations back on Trump and his cabinet. Really? Did she really do that? I don't think so. Federal Reserve Governor Lisa Cook pushed back on President Donald Trump's revived effort to remove her from the central bank. Allegations of mortgage fraud lodged against Cook by the Trump administration remain unfounded and untrue. Oh, her attorney said they were unfounded and untrue. So then hey, case closed, end of story. Nothing more to see here, everyone. Her attorney noted that Trump and others in the administration, including Treasury Secretary Scott Bessent and Attorney General Todd Blanche, have been accused of similar conduct. I don't think so. And then we see this, Fed's Cook says she never committed fraud. Lawyers for the Fed governor, Lisa Cook, said her mortgage documents provided no legal basis for Trump to remove her. So a lawyer for the Federal Reserve Governor, Lisa Cook, told the White House on Wednesday that his allegations that she committed mortgage fraud are unfounded, a response to the Trump administration latest threat to try to fire her. So again, we're going to keep an eye on this. The bottom line is this. She got caught red-handed. And just like we had a major scandal where a couple of the Fed chairmen in Boston and I'm sorry, not chairman, governors, a couple of the Fed governors in Boston and Dallas got caught doing massive insider trading. And when they got caught, you know what they did? They resigned. They resigned immediately to try to, save the Fed from embarrassment, try to save themselves from embarrassment, and try to, just go under the, just go under the, sweep it under the carpet, so to speak. That's what happened. Now, Lisa Cook, she gets caught blatant mortgage fraud. And her response is, yeah, I'm not going anywhere. I'm not doing anything. I think that this is an embarrassment. It's an embarrassment to the Fed. It's ridiculous that somebody who could get caught for this stuff would stay on there. She should have resigned. She should have resigned and stepped away and just let this get swept under the rug. But no, they're going to drag this thing out to the bitter end. The sad thing is that ultimately, does she get fired? Probably not. Probably at the end of the day, probably not. Probably nothing happens to her at the end of the day. But should she remain there? I don't think so. I don't think she should remain there. I think she should have resigned and should have left, and that should have been the end of it. But no, she's going to fight this sucker to the bitter end. All right, now we're going to come back here in a minute. We're going to get into the Mark Walters thing here and a little private credit conversation. But first, let's switch gears here. I want to get into our economic indicators for this week. So let's jump into this. So Monday, August 31st, we got nothing scheduled for Monday. On Tuesday, September 1st, we get the U.S. manufacturing PMI, the ISM report on business manufacturing, construction spending, job openings, and labor turnover survey. On Wednesday, September 2nd, we get the ADP, National Employment Report, factory orders, and the Federal Reserve Beige Book at 2 p.m. On Thursday, September 3rd, we get the U.S. trade balance, weekly jobless claims. The Federal Reserve Governor Christopher Waller is going to speak at Reuters. U.S. services PMI, ISM report on small services PMI. Federal Reserve Bank of Cleveland President Beth Hammack and the Federal Reserve Bank of Chicago President Austin Goolsbee special remarks at Connecting Communities online event. So again, much more of these governors coming out and speaking their stuff that Kevin Warsh doesn't really want them to be speaking. Friday, September 4th, we get unemployment report, unemployment rate, average hourly earnings, and average hourly earnings this month over month and year over year. So those are your economic indicators for this week coming up. And like I said, we'll get into more of that Let's see. Hold on. Let me get into my bank news here. So let me give you guys some bank news, and then I want to go over the 5 episodes that I put out this week. So let's jump in here. So new home sales drop in July. Consumer confidence dips in August. Home prices increase in June for the second quarter. So home prices increased 1.5% in June from the same time a year ago, following a 1.2% annual gain in May. Mortgage applications dip in weekly report because of interest rates going up, of course. Durable goods orders increase in July. Personal income and spending rise in July. GDP was up 1.5% in the second quarter, according to the second estimate. The gross domestic product increased at an annual rate of 1.5% in the second quarter, according to the Commerce Department's second estimate, following a 2.1 increase in the first quarter. Housing data. A typical family needs to allocate 34% of income for mortgage payments. So a typical family in the U.S. would need to allocate 34% of its pre-tax income to cover the mortgage payment for a median priced home, according to the quarterly NAHB Wells Fargo Cost of Housing Index. Regulators close Pennsylvania Bank, the fifth bank closure in 2026, but I'll talk more about that in a minute. The St. Louis Fed Community Bank Ag lending is up. The value of outstanding agricultural loans at community banks stood at 162.6 billion at the end of the first quarter, up 4.6 from a year ago, 4.6%. ICBA opposes Dakota Ridge National Trust Bank charter application. Nissan withdraws their ILC application. So Nissan Motor Acceptance Company withdrew its application to the FDIC and the Utah Department of Financial Institutions to form an industrial loan company based in Salt Lake City. OCC announces additional updates focused on material risk. So, in addition to the FDIC OCC rule on material financial risks, the OCC announced additional actions to focus supervisory attention on the most significant risks and violations. Yes, so we're going to get more on that in the coming weeks for sure. FDIC proposes rule to implement ICBA advocated reciprocal deposit change. So the FDIC Board of Directors approved an interim final rule to amend the statutory framework governing reciprocal deposits in line with an ICBA advocated provision of the 21st Century Road to Housing Act. So regulators issue final rule prioritizing material financial risks. So the FDIC and the OCC issued a final rule designed to focus examiners and institutions' attention on material financial risks and compliance with banking and banking-related laws and regulations. So, yeah, like I said, so the OCC announces additional updates focused on material risks, and the FDIC does as well. So, again, like I said, there'll be more to come on that in the following weeks. ICBA stablecoin debate needs a Main Street credit test. A new ICBA article asks if local deposits migrate into stablecoin reserves, what happens to the credit those deposits support? Well, in theory, they would dry up, but we're not quite 100% sure as to what's going to happen yet. So, but ICBA supports Fair Exam Act. ICBA expressed support for the Senate version of the Fair Audits and Inspections for Regulators Exams Act, which would improve the bank examination environment by creating a workable appeals process. Okay. Latest credit union acquisition highlights the need for a tax policy change. Yet another tax-paying community bank was reportedly acquired by a billion-dollar credit union. ICBA said Congress should discuss credit union tax and regulation exemptions. Yes, they absolutely should. Agencies rescind SPCP statement. Federal bank regulators rescinded the interagency statement on special purpose credit programs under the Equal Credit Opportunity Act and Regulation B, dated February 22nd, 2022. The CDFI Fund names a new director. Community Development Financial Institutions Fund named Chris Miller its new director. Congratulations to Chris. Treasury establishes Quantum Readiness Task Force. So the Treasury Department announced the launch of a task force to strengthen cryptographic protections for U.S. sensitive data and critical infrastructure. So interesting. ICBA to agencies subject non-bank stablecoin issuers to rigorous customer identification rules. So ICBA said permitted payment stablecoin issuers must be subjected to rigorous enforceable customer identification program requirements that are equivalent to those applied to banks. Yes, I agree with that absolutely. SBA proposes upping small business threshold to $5 billion. The Small Business Administration proposed changing the asset threshold for small banks from 850 million to 5 billion. The effort to simplify small business classification and expand access to federal programs would mean 760 additional banks would receive the regulatory relief that is needed or is that regulatory relief that is tied to the SBA definition of a small business. So yes, very interesting there. Very interesting moves on the part of the SBA. So, all right, now very quickly, I want to get into the episodes that I put out this week. So, um, all right, last week I did on last Sunday put out a bonus episode, BND Strategy Room bonus. Private credit liquidity and default issues continue. So, private credit has a liquidity issue as loan defaults continue to increase while cash redemption requests have calmed down a little bit. They continue at a concerning pace. At the same time, money inflows into private credit funds have slowed dramatically and loan defaults continue to rise. This mix of events is leading to liquidity issues. But what does liquidity mean? That depends on who you ask in the private credit world. The goalpost has moved from everything is fine, nothing to see here, to we are in a credit cycle and there will be some losses. Next stop, who could have seen this coming? So, yes, very interesting update on private credit there. And then on Monday, I did the FDIC and the OCC are looking to increase de novo bank applications. So, the FDIC announced a new deposit insurance application process. This will be a two-phase process used to evaluate new applications to speed up the review process. The FDIC will provide de novo applications who satisfy requirements with a contingency authorization within 120 days of receiving the application. The idea is to make the process more efficient by getting a green light before organizers spend significant capital and time to form a new bank. So yes, very interesting update there from the FDIC and the OCC. And then I followed that up on Tuesday with why form a startup bank and how to do it. Why would someone want to start a de novo bank? If you wanted to, how would you go about it? What is the process? So this episode tried to answer those questions. First, if you want to start a de novo bank, you got to focus on the why. What is a compelling customer problem and how will you solve it? Uh, what is your niche? Why would a customer switch to your bank? A good example is Bird in Hand Bank in Lancaster County, PA. This bank was built to specifically serve the Amish community. Another consideration is local community relationship banking versus national product centric fintech platform. Let the why drive everything. And then, second, if you want to start a de novo bank, you should follow these 7 steps. Number 1, team and governance. Number 2, seed money. Number 3, choose the niche. Number 4, 3-year business plan. Number 5, choose charter type and file. Number 6, raise capital. And number 7, build infrastructure and tech. So yes, so again, I thought that was a really great episode. For anybody who's interested in de novo banks, how you might start one, what should you consider, what should you be thinking about? Great episode for that. On Wednesday, I did Tioga Franklin Savings Bank becomes the 5th bank failure of 2026. So Tioga Franklin Savings Bank in Philadelphia becomes the 5th bank failure of 2026. The bank had 68 million in assets as of June 30th. The FDIC estimates that the failure will cost the Deposit Insurance Fund approximately 5.5 million. Second Federal Savings and Loan Association assumed all the single branch bank's deposits and most of its assets as the FDIC acted as receiver. Now, what I point out in that episode is that there's starting to be a pattern that is forming amongst these more recent bank failures, and that is these are smaller banks, um, usually like 100 billion or less I'm sorry, 100 million, not 100 billion, 100 million. 100 million or less in assets, meaning they're very small, very tiny banks. But they also have a pattern of being disciplined and being tagged by the regulators. Like these are not situations where they just came out of the blue one night and then bang, magically everything went wrong. That's definitely not what happened here. We are seeing a pattern of just kind of abuse, negligence, just bad management at the top, and then after a couple years, the regulators finally say, okay, we've had enough, and they pull the plug. So it's just like I said. So very interesting episode there. Fifth bank failure of 2026, and so if you're interested, go and check that out. Then and this episode that I did on Thursday leads right into the conversation we're about to have on private credit here. So I did private credit plus private equity plus life insurance equals Mark Walters' $1 billion margin call. So Mark Walters, the CEO of Guggenheim Partners, big Wall Street player, and owner of the Dodgers and Lakers, received what amounted to a $20 billion regulatory margin call. This forced him to sell the Lakers very quickly and scramble for additional funds. This event shined a light on the ties between private equity, private credit, and life insurance companies, which led to major concern among state insurance regulators and federal regulatory authorities. Mr. Walters' insurers apparently lent more than 20 billion of policyholder money to his own private entities without properly disclosing the affiliations. The problem here is that this is not a one-off or isolated incident. It is a peek behind the curtain into a much larger game on Wall Street that has been going on for a while now, flying under the radar. The question is, will the regulators be able to clean this up before another major blow up occurs? So, yes, that was interesting for Thursday. And then Friday, I did another bank news episode that was going to be called Bank News Insider Trading, CFTC bans, SEC crypto rules, and camels in question. So again, the format. I'm really enjoying doing those bank news episodes. They're really nice because I basically get 10 or 12 articles that for the week, all bank news. I basically put them out, and I try to do it in about a 15-minute episode, just to try to get people kind of general banking news for the week, get them in, get them out, that kind of thing. And people just really seem to be liking that format. They seem to be liking that. And a lot of times it's also a lot of episodes that like I don't have the extra time to cover on the live stream, right? So like I don't have the time to cover it. So I try to cover a lot of that stuff in those bank news episodes. So if the live stream isn't enough for you and you just need more, go check out those bank news episodes, which I basically been trying to do pretty much every week now. So all right, so those were the 6 episodes that I had out this week. And as I always note, I usually new episodes every Monday through Friday, usually premiering at noon, up on YouTube, Rumble, and all major podcast platforms. So, okay, now with that all being said, let's jump back into our articles here. So we just talked just a second ago about Mark Walters and his $20 billion regulatory margin call. Now, things developed this week, right? Things were playing out, and basically, Mark Walters, TWG Global, says there's no fraud amid probe of insurers' disclosures. So Mark Walters, TWG Global, blasted what it called multi-pronged attacks against the holding company and its subsidiaries, and said, despite what has been reported, there has been no fraud at these companies. The statement came amid a flurry of media reports about Walters' empire and federal criminal and civil investigations into the accounting and related party financial transactions by 2 of his insurers. TWG is not looking to sell its sports assets at fire sale prices to raise capital for its insurance operations yet. But yet they sold the Lakers real quick, didn't they? Sold the Lakers real quick. Yeah, the sale of the Dodgers upcoming, ladies and gentlemen. That will be coming up very soon. Um, Now, here's the thing here. Did Mark Walters and his companies, did they do anything illegal? No. I don't believe they did anything illegal. But what did I say here in the episode that I just did on Thursday? What did I say? I said that this event with Mark Walters and his companies and Guggenheim and everything, it shines a light on the ties between private credit, private equity, and the life insurance companies that they have either buying into or buying their stock up or whatever. And the problem here is that Mr. Walters insurers apparently lent more than $20 billion of policyholders' money to his own private entities without properly disclosing it. There you now you're into major ethical and moral boundaries, right? Okay, that might be legal, but but was that ethical? Should you be doing stuff like that? What happens if something happens and all of a sudden one of these life insurers gets, a whole bunch of claims at once on life insurance policies, and now they don't have the cash to pay out? What happens then? Is Mr. Walters going to pony up to solve that problem? I don't think so. I don't think so. Highly doubt it. And that's really this web, if you will, between private credit, private equity, and the life insurance companies. That's what is of real concern here. Is that how deep does this web go? What is all interconnected here? And it's a mess. I think it's a mess. Here, Mark Walters' troubles are disrupting the insurance world's hottest trade. So investors are questioning a 4.1 billion takeover of Bright House Financial because of some parallels to Walter. Yes, like what I said, this is not a one-off situation. It's not an isolated situation. That's what makes it so interesting. So turmoil in Mark Walters' financial empire is spreading, shaking Wall Street's confidence in one of its most lucrative trades. A federal investigation of how Walters used life insurers he owned to finance his other businesses has drawn greater scrutiny to the now common practice among fund managers of snapping up insurance companies so they can invest the insurers huge troves of policyholder money. So in other words, they're buying up these life insurance companies so that they can rate them. They want to rate them. They want to loot the cash piles. This is raising doubts about the planned 4.1 billion purchase of life insurer Bright House Financial by Aquarian Holdings, an investment firm run by Rudy Sahe, a former executive at Guggenheim Partners, one of Walter's companies. Bright House's share price has dropped about 20% since late July when the Walter investigation was reported, reflecting investor skepticism that the deal will go through. In one sense, Walter is an isolated case, but in another, it brings attention to how insurance companies have been investing much more in private securities, said Peter Troisi, an analyst at Barclays. The question is, what is this a sign of there being too much risk, and will there be a fallout from that? Yes, exactly. Now, um, who reported? Who reported? Was telling you, has been telling you about private credit and all these issues with private credit for the last year and a half? Who? Who? This guy? This guy? um I'm not gonna do the victory lap just yet. The victory lap is coming. It is coming. It will be sometime in the not too distant future, but it's coming, but not today. Not today. We're not gonna go there today. Um, but again, this is the problem, is that it's rolling out these different things here, right? And like we're starting to, the rock has been lifted up, and all of the, as Jamie Dimon likes to call them, all the cockroaches are beginning to scatter and run about. And that is the biggest issue here. What does this become of all this? And that's the thing, we don't know yet. Now, another thing on the private credit front. So private credit's chills draw bargain hunters offering cash to trapped investors. So business development company investors snubbed earlier discounted cash out offers, but some could now have a second chance as the industry woes mount. So now the vultures, basically the vultures are circling, if you will. So discounted offers for business development company shares and assets are getting steeper as the months-long wait endured by some private credit investors eager to exit continues. The cash out opportunities represent one upshot of the chills rippling through the private credit industry over concerns about certain software company debt. So in other words, what's happening with this is that, so say you are a private investor and you've got 20 million invested into a private credit fund. You've gone to the fund and you said, "Hey, listen, I'd really like to pull my company out of this fund." And they go, "Well, we could give you a tiny little bit. Like, so you invested 20 million. We might be able to give you 500,000 back, but we have redemptions capped at basically 5% every quarter. So we can't give you the whole thing because we've got a ton of other investors who want their money out as well. So we'll give you, little snippets, 500,000, whatever here and there." Now, obviously, if you're worried about this fund, completely falling apart, getting 500,000 every month for like the next, 8 years that's not going to help you, right? So enter these discount offers, right? Where somebody might come in and they might say, "Hey, tell you what, here's what we'll do. You've got 20 million invested in here. We will buy you out right now for 12 million bucks. We'll give you 12 million dollars, and then we'll take over your position. You could get a big chunk of your cash back, and yeah, you'll take a bath. You'll end up losing 8 million, but it's better than maybe losing more than 50% or all of the investment, right? If the fund should tank, right? So then they have to take that into consideration. Now, these guys, these secondary buyers, basically they're hoping that the situation is not as bad as maybe what people think, and that they buy that guy out for 20 million, and that maybe they can milk some of that money out over time, and that eventually they'll recoup more than the 12 million bucks that they've offered to pay them on that investment. So that's kind of the theory there for what's happening now. But like I said, just yet another wrinkle in the private credit landscape, and we'll continue to keep an eye on that. So now, couple other things here real quick. I just want to run through kind of some general news, and then I want to get into a conversation around NVIDIA. So just a couple things here. Investor competition for commercial real estate sees its strongest growth in a year. So bidding for properties in June posted its strongest monthly improvement in a year, according to quarterly bidding and credit indexes released Tuesday from JLL. Specifically, investors are flooding into the retail and industrial sectors. The weakest sector for bidding and credit activity continues to be multifamily. Isn't that interesting, right? So we're seeing a little bit of a shift here. Office property, of course, continues to be persona non grata. So it's like, I see the office people out there right now. What about office? What about office? Like, nah, sorry, man, we got nothing. Get out of here. Take a hike, office. We got nothing for you. But yeah, so it seems like investor sentiment and money is beginning to shift back over into retail and industrial sectors, and multifamily beginning to cool, beginning to wane a little bit. So just very interesting there. Wells Fargo and Citigroup have room to buy a big bank. These five regionals fit the bill. Very interesting, right? So Citigroup and Wells Fargo are the only U.S. mega banks with room under the 10% national deposit cap to buy a large regional bank, but neither has moved. Now, what's interesting about that 10% national deposit cap is it depending on some of the numbers you look at, they're actually over that cap. I know JP Morgan is over that cap. I thought that Citigroup and Wells Fargo, maybe they're not. I mean, maybe they're not, but I kind of thought they were, or were pretty darn close to it. But anyway, I digress. But Wells Fargo CEO Charlie Scharf has signaled openness to a transformative deal, while Citi CEO Jane Fraser says the bank's focus is on organic growth, not M&A. Despite looser regulatory barriers, North America bank merger value fell by more than half in the first 6 months of 2026, according to EY. Bain projects 1 to 3 new 1 trillion plus mega banks by 2030 as the number of regional banks shrinks from 49 to as few as 30. So that's very interesting. Yeah, Bain I need to cover that in an episode. Yeah, Bain Capital basically put out this research report where they basically said that, yeah, the bigger banks are going to continue to get bigger, and we are going to see a shrinking of regional banks. Probably somewhere in the neighborhood of 10 to 20 regional banks are going to go out, and the bigger mega banks are just going to continue to grow. We'll see more than four banks with $1 trillion balance sheets here. But what are the banks that they're looking at here? I just want to take a look here. What they said that these five banks. Um, I don't know if they really said if they really give us like the five banks that they may target or maybe looking at. But again, I have talked a couple weeks back. I probably talked about maybe even a month or so back, but Citigroup. So Citigroup really needs deposits. Like they really need to bring deposits, and this is kind of funny. I didn't realize that Rachel Maddow had become the CEO of Citigroup. I'm sorry, but I mean, come on, man. Look, that's funny. That's funny. It's Rachel. It's either Rachel Maddow or it's her long lost sister. Anyway, um, but Citigroup really needs deposits, and one of the easy way for them to get deposits would be to probably just pick up a large regional bank where they could add 4 or 5 600 million in deposits real quick to the balance sheet. That would really help them out. And I think of any of the big banks, the most likely one to buy another large regional bank would be Citigroup. Despite the CEO basically saying over the last couple of weeks that she probably wasn't going to go that route, and they probably weren't going to do a merger. I think it's more likely that yes, at some point they will look to buy something. Wells Fargo, maybe, maybe we'll see. But like I said, that Bain Capital report though was a very interesting report, and I need to do an episode, do a little bit deeper dive on that, do an episode talking about that. So okay. Um, if I'm saying this right, Oyora and Dunkin', basically Dunkin' Donuts, getting ready to join the IPO bonanza. Investors are sizing up the parade of new offerings expected in the coming months. So yes, we are going to get a lot of IPOs here in the next couple of months. The final weeks of summer are typically quiet on Wall Street. This year, a parade of initial public offerings expected after Labor Day is making a lot of noise. Fund managers and analysts say their calendars are full of meetings with companies eager to gauge investor interest for upcoming offerings. Obviously, we had the major one from SpaceX, and obviously Anthropic and OpenAI trying to get in on the act, and that has brought a whole lot of interest with a lot of companies trying to get into the fold here. So we will keep an eye on this one and see how things continue to play out there. This is kind of a wild story. The world's craziest stock market has turned into a fright ride. A slow motion collapse in South Korea's Kospi index erased 2.5 trillion in market value, burning investors who bet on the AI boom. Now, I don't want to get like super deep into this, but basically, yes, South Korea's stock market. I've been kind of keeping an eye on this, but their stock market has just been on this crazy roller coaster ride the last month or so. Their stock market crashed and then kind of bounced back. And like I said, I'll probably get into this at a later date because it is like, I mean, yeah, I mean, you see here the 1 month realized volatility in this chart. I mean, look at that. I mean, it basically went up to 77, plunged all the way down to 31, and then has shot right back up to 100. I mean, just like, I mean, wow. What a roller coaster here over the last few months here in South Korea. So like I said, um I think I'm going to let this one marinate, if you will, for a little bit, and we'll come back. We'll talk more about this in the next couple months, because I have a feeling that the roller coaster ride is not over there yet in South Korea. But again, a lot of this coming on the AI trade. A lot of people jumping on that AI bandwagon, looking for the AI trade. And like I said, we'll continue to look at that in a second. Now, all right, before we get into the NVIDIA, just a couple other things I wanted to run through here real quick. So 52% of Gen Z investors have redirected investing money to sports betting. Ah, man, this kills me because, I have been talking for months about um Kalshi and poly markets and this effect of gambling. I have criticized all of the major sports leagues. I mean, it's just ESPN is ridiculous for I mean, they promote gambling on ESPN 24/7, 365. They've got their deals with DraftKings, and the other big I can't think of the other one, is skipping my mind at the moment. But again, like, this is not good. All of this stuff with Kalshi and Polymarket and DraftKings, this all of this betting, the sports bets, it is not good. This is not good. It's kind of funny that in what the 50s, or not the 50s, in like the 60s and 70s and in the 80s, we had smoking, right? And then all the smoking advertisers, they push smoking. And then what do we find out? Oh, well, smoking leads to cancer and leads to all kinds of other problems. Smoking's bad. So then they get off of smoking in the 80s. They turn toward what? Alcohol, beer. And then we get a major push for 20, 25 years in beer. And then they're like, oh yeah, you know what? We're actually, we've actually created a lot of alcoholics, and we're driving people, people are showing up doing crazy things at our sporting events because they're drinking too much. So maybe we need to go around that. So now they just continue to move from one vice to the next to the next. And now they're on to gambling. And this is going to end is probably worse than the other two did. And it's like, when are we going to wake up and realize that this is a horrible thing, and it's the younger generation that's going to become a bunch of gambling addicts. Just not good. And I saw, and I didn't have it. I was trying to find it before I came in here, but I had seen a local article on a Pennsylvania paper here about the increase in women gambling, and how it's really leading to a lot of negative, of course, as it would, a lot of negative outcomes, for young women. But again, just it's not good. This is just not good. Trump declares national emergency to secure U.S. power grid from foreign cybersecurity threats. So the order bans some foreign equipment for being used in the U.S. power grid. So yeah, so there was a huge China had a huge cyber attack this week. Not good. Has now led to this national emergency, and a national declaration, and we'll see where that goes. Canada blew up with we have about a big trade battle now with Canada. U.S. Trade Rep Greer blames Canada for failed tariff talks. They wanted more. Then we get into U.S. and Canada are bracing for a prolonged trade dispute. Few see an off-ramp as Trump faces political pressures in advance of midterm elections. Then we run to Trump announces 50% tariffs on Canadian autos. Canada says its counter tariffs will come into effect on September 8th. And sure enough, they followed that up with Canada unveils retaliatory tariffs on about $20 billion of U.S. goods. Now, here's all I'm going to say on Canada. Canada has brought all this on themselves. I do not fault President Trump for going after them one bit. The tariffs that Canada has had on the U.S. for decades has been ridiculous. I mean, we've got things that they've got 250% tariffs on. 250%. It is disgusting what can, and then not to mention the fact that we subsidize them every year on an annual basis to the tune of $250 billion a year. So between the subsidies and their ridiculous tariffs on us, if that's what you call a friend, I'd hate to see what an enemy looks like, because it's utterly ridiculous what Canada has been doing to us. And and so again, I don't blame him one bit for going, like, yeah, I think it's fair to say that, yeah, Canada, you're not treating us very good. Why do we have to subsidize you? Why do we have to give you 250 billion a year? Why are you hitting us with these ridiculous tariffs? Why are you bludgeoning us with these tariffs? Why, if you're such a good friend and trading partner, why can't we have an even playing field across the board, right? Just simple question there. So again, I don't think this is going to end anytime soon. I wouldn't be surprised if this escalates, but All the cards again are in our they're in the US's favor here because because the relationship was so out of whack, it was to be in disbelief. So I mean, so Canada, yeah, okay, they could put their 20 billion, all right, whatever. Whatever. Like seriously, like, it's not gonna do anything to us at the end of the day. They're shooting themselves in the foot. So whatever. So we'll see. Um, Meta agrees to pay 18 billion in social media addiction settlements. What to know? So the multi-state agreement is one of the largest consumer protection settlements in U.S. history and will likely impact all of social media platforms. Yes. And then we take a look at this. So Meta reaches 18 billion settlement with 48 states over child safety claims. The deal contains broad new safeguards for underage users, but only pays out in full if TikTok and YouTube make similar concessions. So, first of all, I think it's ridiculous that they let Meta settle, because now Meta is they're going to escape all of the scrutiny here, all the scrutiny. Um, did I necessarily want to see like some, trillion-dollar, judgment that was going to, potentially put Meta out of business? No, not necessarily. Did I want did I want Zuckerberg and all of his executives to have to get up on the stand and testify and basically air all their dirty laundry and all the unscrupulous things that they've been doing for years and how they have manipulated people psychologically with the app? Yes. Oh yes. Oh yes, I wanted that. I wanted that because that would do irreparable damage to Facebook and Meta and Zuckerberg and his whole crew over there. It would do irreparable damage. They know that. That's why they settled. That's why they paid $18 billion here to settle this. It's like right quick. And believe me, TikTok and YouTube, they will be right behind them. They will settle as well. I think this was a major missed opportunity because like and then they could sit there and say that there's going to be these new safeguards and all this stuff or whatever. That remains to be seen. Is anything really going to change? I don't know. I don't know if anything changes here, but I think this is just ridiculous that they settled this the way that they did. They should have put these guys on the stand and let them, sunlight is the best thing. The best disinfectant is sunlight. They should have brought these guys into the sunlight. Now they'll continue again to just do what they do and sweep this all under the carpet, and it's a travesty. Anthropic expected to tell investors it sees over 30 trillion in potential. Yeah, okay. Okay. Yeah, okay. This is called we really need to get that IPO done, man. It is slipping through our fingers and we really need to get that IPO done. The reason for the tech backlash, as you can imagine, this was Jeffrey Tucker. I don't have enough time to get into this whole thing here. I'll probably come back to this next week. But then we get into data center opponents are using a unique legal strategy to challenge developments. Basically, nuisance lawsuits, just endless nuisance lawsuits, basically just killing these data centers, basically just using this as a great tactic to just slow everything down. Because if you slow it down long enough, they will basically throw in the towel because they will miss the boat. This is all about getting it in before you miss the boat. Corporate America cut a big checks to Trump, and now CEOs fear subpoenas are coming. Tech firms are courting Democrats and hiring advisors to prepare for potential investigations if Republicans lose control of the House. So again, not corporate America, but big tech in particular. And is it any look, these guys are flavor of the month. They will take the wind and they will go wherever the wind is blowing. Okay. Trump was coming back in, so they cozied up to Trump. If Trump's on his way out the door, they'll cozy back up to Democrats. These guys don't care. They've bought all of Congress and the Senate, so they don't care. Like they'll continue to spread the money around and get what they want. It's a sad thing. Employers express doubt over their AI hiring tools. So I thought this was interesting. I'll make this a little bit bigger here. So 73% of employers using AI in hiring, yet only 57% believe it improves outcomes. 47% said AI has filtered out candidates they would have advanced personally. 51% said they are confident AI is used fairly in layoffs, while 23% said they are doubtful. Yes. But 47% said that AI filtered out candidates that they would have advanced personally. That sounds like a big, big problem. Big problem there. Vanguard Group, they acquired an AI wealth platform called Altruist and financial advice push. I thought this was very interesting. So they basically paid Vanguard paid $4 billion for this Altruist company. And basically, this is, oh, did I miss an article there? Why Altruist deal is a game changer for Vanguard in a rivalry with Schwab and Fidelity. So Vanguard Group acquired Altruist to compete with Schwab and Fidelity in the custodian business. Altruist's technology platform combines custody with digital account opening, trading, and portfolio management. More investment advisors using Vanguard's technology will likely bring more money to Vanguard funds. Maybe, maybe. We'll see. But it's just an interesting development. Rising costs for employers is expected to grow even more next year. So Aon projects U.S. employer healthcare costs will grow 9.5% in 2027. Employer healthcare cost growth has accelerated from 3.7% in 2022 to 8.8% in 2026. GLP-1 weight loss drugs are impacting pharmacy cost increases. So very interesting there. Again, SBA wants to overhaul small business sizes. Billions of dollars are at stake. So the Small Business Administration aims to reduce industry codes from 979 to 338 categories. About 114,541 companies would gain eligibility for federal small business programs. Semiconductor manufacturers would see employee maximums rise from 1,250 to 2,800. So very interesting indeed. We will keep an eye on this one and follow up if some of this stuff comes to pass. Housing costs have surged, but what about the size of new homes? That's a good question. So new homes shrank 11.6% since 2015, but prices per square foot jumped 71.9%. Sellers outnumbered buyers by 51% in July, creating a buyer's market in nearly 80% of cities. The 21st Century Road to Housing Act restricted large institutional investors from acquiring single-family homes. Yes, but basically, home size is shrinking, the cost per square foot is going up, and sellers are basically outnumbering buyers in July. So yep, we will see there. Kind of what I said at the beginning of the show about it really depends on where you live right now. So okay, let's go back to our Nvidia. Let's see here. Nvidia. Oh, where am I? Nvidia. All right, let's see here. Okay. Now, I've got a bunch of articles here on NVIDIA. I want to run through these relatively quickly here, but this is really important on the AI front, right? So, NVIDIA reports this week they had a blowout quarter, says demand for AI chips is getting even hotter. Their shares rallied as the chip giant forecast 70% revenue growth. Pretty wild, 70% revenue growth in the next year, and defended its financial support of AI companies. Yes, but let's I just want to run through these articles for a second because I want you to see here. So Nvidia's got this blowout quarter. Then we have as Nvidia has become a banker to the AI boom, putting it on dangerous ground. Nvidia's 279 billion supply chain gamble. Nvidia insists it could keep printing money to fund the AI boom. Are you seeing a pattern of concern here? The 1.5 trillion question Nvidia's earnings can't answer. Nvidia is spending $6 billion to build a powerful U.S. alternative to Chinese AI. Interesting. Nvidia agrees to buy Hugging Face for $12.9 billion. And this Hugging Face is a whole interesting shenanigans here, right? But let's go back for a second here. So Nvidia has become a banker to the AI boom, putting it on dangerous ground. Growing financing obligations could compound the pain of a downturn. So, and then look at some of the deals here. Some examples. 105 billion amount that Nvidia agreed to backstop OpenAI lease and Ohio data center. 125 billion amount of residual value guarantees Nvidia would give as part of a 500 billion chip financing plan in partnership with big asset managers. 4.9 billion minimum revenue Nvidia guarantees for cloud company Sharon AI, which it sells chips to under new business models. Can you say stretching yourself way too thin? Yeah. Current financial position looks rock solid to say the least, but the financial engineering it is using to keep revenue growing introduces risks that could eventually cause real pain. Nearly 4 years into an artificial intelligence boom that has brought NVIDIA hundreds of billions of dollars in profit, the company is increasingly tapping its financial strength to keep customers buying its chips. Those chips have become the ubiquitous computational workhorses of the AI boom, a status quo NVIDIA has an interest in maintaining. So, again, I talked last week about the circular finance, right? The circular finance going on. I also did an episode 2 weeks ago. Big tech AI spending has gone off the rails. So I did that episode a couple weeks ago. That was a huge hit, if you will. A lot of people really loved that episode because I did an explanation there of the finance and commitments and how some of this stuff is working and why this stuff leads to a big problem at the end of the day. So again, Jensen here really putting Nvidia, I mean, stretching them beyond belief to get to the end here. And then, like I said, Nvidia's 279 billion supply chain gamble. The AI chip leader is using its financial muscle to win the supply battle, but it comes with downsides. So, in writing large checks to its suppliers, even as it amps up financial backstops for less creditworthy customers, the strategy might help the company skirt supply constraints and realize lofty revenue growth forecast, but it isn't risk-free. Yeah, no, it comes with major risks. Major risks. They are really basically extending an AI bubble, is what they're doing. Nvidia insists it could basically just keep printing money to fund the AI boom. The chip maker says its sales flywheel. Now they have a flywheel is more than robust enough to fund the financial support it gives frontier AI labs and data center developers. So Nvidia was closing on a landmark agreement to help OpenAI secure one of the world's largest planned data center projects when Colette Kress, the chip firm's chief financial officer, pumped the brakes. Concerned about negative investor reaction to a Wall Street Journal report that NVIDIA was in talks to financially guarantee a project expected to cost more than $500 billion, Crest pushed for a scaled back deal, according to people familiar with the matter. In the end, NVIDIA agreed to backstop less than half of the original amount discussed. It was a tactical retreat, but on the broader strategy of using its balance sheet to bolster the AI boom, NVIDIA shows no signs of giving ground. So, and then, we go into the 1.5 trillion question Nvidia's earnings can't answer. So let's look at this for a second. When tech companies started amping up spending on AI about 3 years ago, David Kahn, a venture capitalist at Sequoia Capital, asked a simple question. What was the gap between AI investment and the revenue generated from AI? Back then, he called it AI's 200 billion question. That he estimated was roughly the total revenue needed for investments to make financial sense. It seemed like a lot. In 2024, it became a $600 billion question. In 2025, an $840 billion question. This year, it has jumped to 1.5 trillion. These days, few people seem to care about the answer. Certainly won't weigh on investors this afternoon when NVIDIA, the main chip supplier to the AI boom, reports quarterly earnings. Why not? Well, NVIDIA's immediate demand signals has been strong. Customers continue to buy huge numbers of its AI chips. Tech giants signaled that capital spending on AI was going to stay high when they reported earnings this summer. This will likely lead to another NVIDIA report highlighting fat margins and an eye-popping backlog. Meanwhile, its price to forward earnings ratio is around 19 times. Not high for a fast-growing tech company. The longer-term question is just how durable its results will prove. Ultimately, NVIDIA and other AI chip makers are living on borrowed time. At some point, big spenders will reach a breaking point where their cash piles are smaller and they're unable or unwilling to raise more money from debt or equity investors. If AI turns out to be worth less than it costs, that is inevitable. And he didn't say probable, he didn't say maybe, he said inevitable. Sure, a new crop of AI chip customers could emerge, aided by financial backstops NVIDIA was started providing. Even then, the amount of spending needs to keep NVIDIA's revenue skyrocketing is questionable. Look at the company's sales outlook. An analyst surveyed by FactSet expects nearly 400 billion in its current fiscal year, which ends in January, rising to 570 billion the next year and around 700 billion the year after that. To calculate the revenue investment gap on AI, Khan estimates the total cost of an AI data center is about twice the cost of the chips. Then he builds in a margin for cloud service providers and the AI product company that serves the end user. In his formula, NVIDIA's 700 billion of revenue in 2 years would require about 2.1 trillion of end demand. True, companies have started generating significant revenue from AI. Really? Now, I totally dispute that. I totally dispute that. I really do not think companies have really started generating significant revenue from AI. I completely dispute that. I think that's one of the biggest problems, which is giving some investors comfort. Nah, not really. OpenAI was on pace for about 27 billion of annual revenue in the second quarter. Anthropic's annual revenue run rate was it more than 46 billion for the period. Yeah, I think those are both BS, total BS. I'm calling BS on those revenues from OpenAI and Anthropic. I think that is absolute nonsense. Google, Amazon, and Microsoft are also bringing in revenue, but from different places. But it's still nowhere near enough to answer Khan's question. Until that happens, the AI boom remains a build it and they will come story. Maybe. And then we see from the chart here, NVIDIA's price to forward earnings ratio. So down way low. That is a way low ratio for a big booming, tech company, basically. All right, now I want to. Okay, they're going to invest this 6 billion in this powerful alternative. Last thing I want to end on here is just this whole Hugging Face thing because it is strange. I find this whole thing to be very strange. So Nvidia agrees to buy Hugging Face for 12.9 billion. The information was reported. A source familiar with the matter told CNBC. Now, neither Nvidia nor Hugging Face immediately responded to requests for comment. So again, it's just kind of interesting. Now, this came out. Report says 700 OpenAI agents coordinated Hugging Face breach. I mean, this is incredible. The new report said around 700 OpenAI agents were a part of the Hugging Face attack last month, and 1,200 collaborated through a message board, an unsanctioned message board. 1,200. Like, I mean, holy cow. About 700 OpenAI agents were involved in the breach on AI startup Hugging Face, independent researchers said in an August 26th report. Remember, when this happened, when this initially came out a couple weeks ago, it was oh, this is no big deal, nothing to see here, whatever. We were told that it was like one rogue AI, and now we're told that it was hundreds, 700 agents. OpenAI revealed last month that its AI agents, AI programs that run with minimal human intervention, were the ones that hacked into Hugging Face's system. Wednesday's report by METR and Redwood Research revealed that hundreds of agents collaborated on the attack, about 700 out of 1,200 agents that sent 70,000 messages to each other between June 26th and July 13th on an unsanctioned messaging board. Unsanctioned. This incident is the first known case of an automated agent collective acting offensively without authorization, OpenAI said in a separate investigative report that it also published on August 26th. So we have all this going on, right? And then we get this. Finance a Lot, great follow on X. If any of you have never followed him out there, give him a follow. Really post some really great, interesting stuff. Don't you find it strange that OpenAI instructed their AI to hack Hugging Face and left it running for days? And now NVIDIA is buying Hugging Face for 13 billion to what? Destroy the evidence and block the lawsuits? Almost as if the entire thing was orchestrated. Right, Jensen? Right, Jensen? Very interesting, right? This is a strange thing. And I think there's going to be a lot more to maybe come out. Like you said, are they buying this thing to bury it? I don't know. Seems like it. Very very, but like I said, very interesting. Very interesting. A lot more to come there with that. So all right, So with that, I'm going to wrap up today. I'm going to go into wrap up mode here for a second. Let me get my story of the week here. Let me get my quote of the week. Let me get this stuff up here. But first, wait, I skipped the thing before you. Okay, I need to get my banners up. Where are my banners at? All right. All right. So if you are listening on Apple Podcasts or Spotify, please leave me a review. That would really, really help the channel. I would really appreciate it if you could throw some really good reviews out there on Apple Podcasts or Spotify. If you, I would also say make sure to check out the banker.nextdoor.com, as you can see in the banner right here. A lot of great things up on the website. Make sure to go check that out. Make sure to subscribe on YouTube to get all the latest and greatest via posts from yours truly here. I like to put out, like episodes that are coming out during the week. What's going to be happening? What am I going to be covering on Strategy Room for the week? All that kind of stuff. I post all that stuff up on YouTube. So if you want to get all those latest and greatest posts, make sure to subscribe on YouTube. You could send comments. If you have questions, comments, topic recommendations, anything of that nature, you can reach me at info@thebankernextdoor.com. That's how you get in touch with me. Make sure to follow me on social media. I'm up on Getter X and Truth Social. So, and then BND is on YouTube, Rumble, and all major podcast platforms. We put out new episodes every Monday through Friday at noon, and then BND Strategy Room live stream is on Saturdays. And let's see here, and then I think that's it. That's all I got for you guys right this second, right? It's good. It's good stuff, right? All right, now story of the week. So, central bank digital currency. So, a central bank digital currency uses a blockchain based token to represent a digital form of a fiat currency of a particular nation or region. A CBDC is centralized. It is issued and regulated by the competent monetary authority of the country. No country has issued a CBDC yet. Well, China kind of did. But the term CBDC refers to a virtual form of a fiat currency. A CBDC is an electronic record or digital token of a country's official currency. As such, it is issued and regulated by the nation's monetary authority or central bank. They are backed by the full faith and credit of the issuing government. Central bank digital currencies can simplify the implementation of monetary and fiscal policy and promote financial inclusion in an economy by bringing the unbanked into the financial system. Because they are a centralized form of currency, they may erode the privacy of citizens. No, I don't think may, I think will. They will erode the privacy of citizens. Central bank digital currencies are in various stages of development around the world. Many countries are developing CBDCs in a push to develop greater oversight of digital assets. At least 58 out of 65 central banks surveyed by the Bank for International Settlements, the BIZ, earlier this year said they were exploring launching a central bank digital currency. Now, the European Union, as I reported about 2 weeks ago, they gave their blessing. So they will be issuing a central bank digital currency. We had one of our regulation, what I called the three-legged stool of crypto regulation, was the anti-CBDC Act, which would prevent our central bank from issuing that. That has basically got approved by the House and has died on the vine in the Senate. And my fear is that the Senate will not pick that up and they will not pass that legislation, even though we need it. We do not want a central bank digital currency. So, but that is my story of the week. So now, let's shift gears to our quote of the week. So this comes to us from Aristotle, the Greek philosopher. There is only one way to avoid criticism: do nothing, say nothing, and be nothing. That's it. That's very true. It's from a couple thousand years ago from Aristotle. It was true the day he said it, as true as it is today. So, all right. With that being said, thank you so much for joining me on this afternoon edition of Strategy Room. But I hope everyone has a great weekend out there. I thank you for watching and listening. I hope you enjoy the rest of the weekend. I'll see you guys. New episodes coming out on Monday. I'll see you guys here back in the Strategy Room next weekend. Have a great time out there. Take care. Be good. And don't do anything I wouldn't do, right? All right. See everyone.